All right, let's unpack this. Today, we're diving into the recent financial reports of a major institution, JPMorgan Chase, specifically their Q2 2025 results. And what we found is, well, it's a fascinating story, really. A company that seemingly exceeded expectations on paper.
Yeah, definitely beat the street.
Right, but then still faced this surprising dip in its stock price right after the announcement. So why the disconnect? What's going on there?
What's truly intriguing here, I think, is how you see this interplay. You've got strong core business performance, right? But then you layer on these broader macroeconomic concerns, and it can lead to really divergent perceptions.
Okay.
So our mission for you today is really to cut through the headlines. We're going to explore not just the what of these numbers, but try to get at the deeper why behind them, give you a more nuanced understanding of both the company's health and kind of the market's pulse.
Exactly. That's precisely what we need to unravel. So, okay, let's start with the immediate financial highlights then, the big numbers. JPMorgan Chase reported a net income of $15.0 billion for Q2 2025. And that translates to $5.24 in earnings per share, EPS. Now, this was a clear beat because Wall Street analysts, they were only expecting something like $4.48 or maybe $4.47 per share.
Right.
So on the surface, that sounds like a fantastic win, yeah.
It certainly does, but the picture has layers. Within that impressive net income figure, there was this specific kind of one-time boost.
Yeah.
It was a $774 million income tax benefit in their corporate segment.
Ah, okay, like a one-off.
Exactly. Think of it as a unique non-recurring gain, maybe, I don't know, a specific tax settlement or some adjustment. Analysts typically strip that stuff out. They want to see the bank's underlying ongoing operational earnings more clearly.
Makes sense.
So even when we exclude that, their adjusted net income was still solid, $14.2 billion, giving an EPS of $4.96. So still a beat on the forecast.
Still good.
Still good. However, and this is where the year-over-year context becomes really critical for you, that reported $5.24 EPS, it was actually down 14.4% from $6.12 back in Q2 2024.
Oh, wow. Okay.
Yeah, and the overall net income decreased, too, by 17% compared to the previous year.
Right. So a strong quarter relative to current expectations, what analysts thought now, but a noticeable dip when you compare it to how they did last year. Okay, let's talk revenue then. They reported $44.9 billion, and their managed revenue hit $45.7 billion. Again, these numbers surpassed what analysts were estimating, which was around $43.81 billion. But I imagine there's a similar story here regarding last year. Is it down year over year, too?
Precisely. Total revenue was also down by about 10-11%, actually from $50.2 billion in Q2 2024. And a major reason for this decline was a 20% decrease in what's called non-interest revenue.
Okay, so that's fees and trading, not loan interest.
Exactly. That type of revenue comes from fees, trading income, other sources other than the interest they earn on loans. And the primary driver of that decrease was the absence of a really substantial $7.9 billion net gain they had related to Visa shares. That happened in the prior year.
Ah, the Visa shares gain.
That was a significant one-time boost that clearly wasn't going to be repeated this quarter. So if you sort of factor out that past exceptional item, the current quarter's operational revenue performance looks quite different. More stable, perhaps.
That makes perfect sense. Okay, so we have these beats on current expectations, sure, but these year-over-year declines that are influenced by that specific big gain last year. And despite the beats, JPM stock actually slipped almost 1% in pre-market trading. So this tells us the market reaction isn't just about the numbers themselves. It's got to be about broader sentiment, maybe what the company leadership is communicating. I saw Jamie Dimon, the chairman and CEO. He commented that significant risks persist, including from tariffs and trade uncertainty, worsening geopolitical conditions, high fiscal deficits, and elevated asset prices. That sounds pretty cautious.
It does.
How much do investors weigh these kinds of warnings, especially from someone like Dimon?
Oh, it's a huge factor. And it highlights something really crucial for you, the listener. Investor psychology. It's not always rational, right? I mean, while tariffs might directly impact, say, manufacturing for a major global bank like JPM, well, high fiscal deficits could signal future interest rate volatility or maybe potential regulatory shifts down the line.
Okay.
Geopolitical conditions. They directly affect global trade, investment flows.
Yeah.
That impacts their investment banking, their markets divisions. Investors aren't just looking at the past quarter. They're constantly trying to price in future risks. So when an experienced CEO like Jamie Dimon points to these macro headwinds, these big picture worries, it can immediately outweigh even strong headline numbers. And that drives that cautious sentiment, that little dip in the stock.
That's a really powerful point. It's not just about what happened, but what people think might happen next. Okay, let's shift gears a bit. Let's move to something often celebrated when we talk about JPM, their fortress balance sheet, their capital management strategies. How robust is their financial foundation right now?
Oh, exceptionally robust. I mean, really strong. They reported a standardized CET1 capital ratio of 15.0%
Okay.
and an advanced CET1 capital ratio of 15.1%.
And just quickly, what does CET1 tell us again?
So CET1 stands for Common Equity Tier 1 capital. For you, think of it as a crucial measure of a bank's core equity capital. Essentially, it's how much high-quality financial cushion they have, to absorb unexpected losses. The higher the percentage, the better. And JPM's ratios are, as they put it, far in excess of required capital levels. That signals tremendous stability.
Okay.
And beyond that, their total loss-absorbing capacity reached $560 billion.
Wow.
Yeah. This is basically the total amount of capital and long-term debt they have available to absorb losses without needing a government bailout. It's just a massive safety net.
And when it comes to liquidity, how easily they can meet their short-term bills, they ended the quarter with a massive $1.5 trillion in cash and marketable securities. That's just a staggering figure.
It really is.
What does that kind of liquidity allow them to do, or maybe prevent them from having to do in this market?
Well, it's a huge advantage. That much cash means they are incredibly well positioned to navigate any market volatility, first off. They can seize investment opportunities if they pop up, or simply just continue their lending activities without constraint. It's a sign of extreme financial discipline, really, preparedness. And it's not just sitting there idle. Their balance sheet is actually growing. Average loans were up 5% year over year and 3% quarter over quarter, reach $1.4 trillion. And average deposits also saw healthy growth, up 6% year over year, 3% quarter over quarter, hitting $2.5 trillion. So this shows, continued client trust and actual business expansion.
And they're not just hoarding that cash and growth, they're also actively managing capital for their shareholders, right?
Absolutely.
They distributed common dividends of $3.9 billion, which is $1.40 per share, and they repurchased $7.1 billion of common stock. That seems pretty confident.
It absolutely signals confidence, and the board intends to increase the common dividend again for the second time this year. That leads to a 20% cumulative increase compared to just Q4 2024.
Wow.
So for you as an investor or just watching the company, this signals really strong confidence from management in their ongoing profitability and their commitment to returning value directly to shareholders. That often underpins long-term stock performance, that belief from the top.
Yeah, definitely. So, okay, we've looked at the big picture, the bank's rock-solid foundation. Now, let's maybe open the hood a bit, see which engines are really driving performance within their different business segments. We should probably start where most of us interact with JPM, their consumer and community banking, CCB.
Right, and CCB had a very strong quarter. Net income there was up an impressive 23% year over year to $5.2 billion.
Okay.
Now, while their average loans were kind of flat quarter over quarter, only up 1% year over year, and deposits were a bit mixed, what's really telling here, I think, are the engagement metrics. They're active mobile customers, up 8% year over year. They're reaching nearly 60 million now.
60 million mobile users.
Yeah. And this isn't just a big number. It really reflects JPM's successful digital transformation, which is crucial, right, for efficiency, for reaching a younger demographic and driving long-term value beyond just the current quarterly earnings. Plus, their debit and credit card sales volume increased 7% year over year, hit over $487 billion, shows strong consumer spending activity.
And it sounds like they're continuing to innovate in that space, too, launching a refreshed Sapphire Reserve card, a new Sapphire Reserve for Business.
Okay.
The sources mention positive early reactions and strong new card acquisitions there. It's also worth noting the card service's net charge-off rate was 3.40%.
Yes.
What does that rate tell us about consumer credit health right now?
So a net charge-off rate is essentially the percentage of debt that a bank basically gives up on collecting. They write it off as a loss. So a 3.40% rate means that for every $100 in credit card loans, about $3.40 was deemed uncollectible during that period.
Okay.
This rate is typically watched really closely as an indicator of consumer financial health and credit risk. For JPM, it reflects, I'd say, a managed level of credit risk within their card portfolio, but it's definitely something they'll always monitor closely, especially given any economic uncertainties out there.
Right, always watching that consumer pulse. Okay, moving to the Commercial Investment Bank, the CIB. Did it echo that consumer strength, Or did it face maybe different challenges in its more institutional markets?
Well, the CIB was another powerhouse, actually. Net income there was up 13% year over year to $6.7 billion.
Strong.
Very strong. A real standout here was investment banking fees. They surged 7% year over year and 12% quarter over quarter. And they maintained their #1 global ranking. They captured 8.9% wallet share year to date.
Wallet share, that's their slice of the total fee pie.
Right.
Yeah.
Exactly. It's the percentage of the total fees paid by clients for investment banking services like M&A advice, underwriting that JPM captured.
Yeah.
Maintaining that top spot signals their continued dominance,
Mm-hmm.
advising on deals, facilitating transactions globally. It's a big deal.
Yeah, definitely. And their markets revenue, that's from trading activities, that was also quite robust.
Very robust, up 15% year over year to $8.9 billion. Both fixed income markets and equity markets saw impressive gains, 14% and 15% increases, respectively. Plus, their average client deposits in this segment were up significantly, 16% year over year and 5% quarter over quarter. So businesses and institutions are trusting them with more money, too.
Okay, and the third major piece, asset and wealth management, AWM.
AWM also performed well. Net income rose 17% year over year to $1.5 billion. Their assets under management, or AUM, that's the total market value of assets they manage for clients, reached $4.3 trillion.
Trillion, wow.
Yeah, an 18% increase year over year. And client assets overall, which includes stuff held in custody, crossed $6.4 trillion, up 19% year over year.
What's driving that growth? Just markets going up?
That's part of it, higher market levels boosting asset values, but it was also driven by continued net inflows. That means clients are actually bringing new money to JPM to manage.
Ah, okay.
They saw long-term net inflows of $31 billion and liquidity net inflows of $5 billion just for the quarter. So that reflects strong client trust and, yeah, those positive market dynamics helping out too.
So, okay, we have this really complex picture then. Strong current quarter performance against what analysts expected. Impressive growth across key business segments like CIB and AWM, a truly robust balance sheet.
Right.
But then we have those year-over-year declines in the overall net income and revenue, largely because of that huge Visa gain last year disappearing from the comparison. And the market's initial sort of cautious reaction despite the beats. What are some of the other challenges, or maybe the outlook JPM is presenting for the future?
Well, beyond that unique revenue comparison issue from the prior year, they also reported credit costs, $2.8 billion provision for credit losses for the quarter, with $2.4 billion in actual net charge-offs, predominantly in card services again.
Right.
These charge-offs are the loans actually written off as uncollectible, mostly consumer credit.
Okay.
Looking ahead for the full fiscal year 2025, they expect net interest income to be around $95.5 billion, but that's very market dependent, as they say. And adjusted expenses also, around $95.5 billion. Their forecast for the full year 2025 card services net charge-off rate, they expect it to be around 3.6%.
So slightly higher than the current quarter's rate.
Exactly. It signals maybe a slight increase in expected credit losses going forward. Reflects maybe a bit more caution on consumer credit health for the rest of the year.
This all kind of brings us back to that initial disconnect we talked about at the start. How do these strategic moves, these underlying business strengths we just discussed, how do they contend with the broader economic headwinds, the regulatory discussions that Jamie Dimon himself brought up?
Yeah.
It's clearly not just about what a bank does internally, is it? It's absolutely not. And this raises that important question for you, the listener. How do these strategic maneuvers and business segment strengths really stack up against those broader economic headwinds, those regulatory discussions that are always in play? Even for financial giants like JPM operating from that fortress balance sheet, the ongoing dialogue around global economic conditions, tariffs, geopolitical tensions, fiscal deficits, and the future of regulation, it continues to be a significant factor, maybe even an outsized factor sometimes, in shaping market sentiment.
Yeah.
The market isn't just reacting to the internal company health report card, it's reacting to the volatile external environment that it operates in.
Right. So as we wrap up this deep dive then, the takeaway seems to be JPMorgan Chase delivered strong Q2 results relative to what analysts were expecting now, showcased resilience, strategic growth across its businesses, especially in capital management, CIB, AWM.
However, the market's more subdued reaction really highlights the persistent influence of those macroeconomic uncertainties, those broader concerns that extend far beyond the pure numbers of a single quarter's report.
Exactly right. It suggests that even the most robust companies, operating from positions of immense financial strength, they're not immune to the collective anxieties about where the global economy is heading. These external forces, as Jamie Dimon himself pointed out, they're constantly shaping investor perception and ultimately the share price on any given day.
So maybe a final thought for you, our listener, as you consider these complex dynamics, ask yourself this. In an increasingly interconnected world, how much of a company's success, or maybe its perceived risk, is truly within its own control? And how much is actually just a reflection of the collective anxieties, those external forces that Jamie Dimon himself alluded to in his comments? Something to think about.